I'm very excited to be here, especially looking after this panel. It's a topic that I'm personally quite passionate about. As introduced, I work for Man Group now, but previously I've worked at Saxo Bank, I've worked at exchanges, brokers, banks, so I feel like very privileged to have worked across the kind of trading and investment life cycle. And it's funny how this topic always has come back to me in every role I've done. So I'll just give you a bit of an overview and then we'll hand over to my lovely panel. So as I said, you know, my experience predominantly has covered various areas, and I would say generally that the things that we know are that regulation has always played a big role in the way that we deal with investors, and historic market events have always impacted investor trust in our industry and investing as a whole. And we know that the population's technical capabilities and interest in investing is rapidly increasing. However, we know that we're still in a position where the level of knowledge and technical capability varies. So what do we need to think about next? We still have some way to go, I believe, where we have to enable and educate investors across the spectrum. And we still have questions outstanding around how will the future regulatory landscape look? Will it still be very protection-based, or will we move to a more strategic enablement phase? And are we doing enough to educate investors and the broader population? And where does that responsibility even sit? And that's probably another whole topic we could talk about. And how do we fundamentally shift the ability and the willingness of the population to invest? Now, you know, we could probably talk about all of those things independently, but today we're here to talk about the how, and this particularly how firms might best democratise wealth management and in doing so, maximise returns. So I will hand over to my panel and let them introduce themselves.
Thanks, Rachel. Roxanne Afsali, Client Success and Sales Director at Avaloq. And what we do is provide software and outsource services to the wealth management and private banking industry. Very excited to be here, just like Rachel, with this panel to discuss democratisation of wealth management.
So I'm not going to try and pronounce the topic, but my name's Nicole, and I head up our wealth management teams for Barclays across the UK, as well as our digital investing commercial teams. So a real interest in this on the basis that in the wealth space, we very much look after clients in the $500,000+ space, whereas in our digital investing space, we're very much looking at entry-level, self-directed, as well as digital advised journeys for clients.
Good afternoon from my side as well. I'm Tamara Kostova, the CEO of UK WealthTech company Velexim, a passionate advocate for the democratization of the wealth management industry, supporting financial institutions to embed investing into their offering set to clients.
Okay, Grant Parkinson. So I head the consumer, private and business banking businesses in Europe for Standard Chartered. A little about Standard Chartered. We're a very different organisation to someone like Barclays. So here in Europe, our focus is very much being a leading advisor for clients from our target footprint markets. So Standard Chartered still has a presence, boots on the ground, in over 60 of some of the most exciting emerging markets around the globe. And what we do for them here in Europe is serve the affluent, high net worth, ultra high net worth needs of those clients when they're looking to offshore some funds outside of their target market, or out of their footprint market, I should say. So a very different approach to what we're doing. We do that here in Europe in two different businesses. We have an affluent business serving clients from $100,000 upwards based in Jersey. And then we have our high net worth, ultra high net worth private banking business here in London, serving clients with more than $5 million to invest.
Okay, on that note, we'll move on to the first question. How can we better incentivise customers to adopt wealth management services? And I think we're going to go to Tamara first for this one.
Thank you very much, Rachel. Most probably first I want to set the stage, defining the size of the opportunity for all of us. So there is an estimated $59 trillion of wealth sitting in the hands of retail consumers. Those retail consumers, I call them next generation wealth consumers, are actually quite different than what we have experienced in terms of consumer adoption into the existing wealth management industry. Those consumers are actually looking to actively manage their personal finance. They are looking to explore, they are looking to make active decisions where to invest and how they would like to grow this wealth. The question is why they're not doing it. And the answer is very simple, because of lack of financial literacy, lack of money management skills. So I think one of the key areas that we have to address within the financial services industry, especially where we are trying to kind of embrace mass retail, mass affluent within the wealth management journeys, how do we actually advance this financial literacy? How we actually teach, educate these clients to have different investing and financial services skills. I want to give you a couple of examples what we see actually here in Europe. By far, by the way, we Europeans, including also Britain, we are way behind in terms of financial literacy within the adult population. I would like to give you examples. 10%, actually less than 10% of Europeans do trade actively or have access to the investing market, despite the fact that 75% would like actually to manage their personal finances. What we see in Southeast Asia is totally the opposite. 60% of all investors are retail. So what is actually the difference? The difference is that, first of all, you have a very eloquent digitalized wealth management journey already embedded in Southeast Asian traditional financial institutions, but it's also about financial literacy. And this is where we need to focus. Great players in the market, most probably emerging. Some of them you have heard them. Go Henry in the UK, My Money in Denmark, offering financial university to children from age 8 to 18, just teaching them how to manage their finances and how to invest. And an interesting statistics out of it is that 100% of the children that graduate these universities become natural investors. They actually embrace investing from day one once they actually get enough money from their parents or just win from their first salary to invest. So I think that ultimately what we're looking at is a much more contextualized, personalized digital wealth management journey for this mass retail and mass affluent client. Rachel.
Thank you, Tamara. Graham, would you like to add to that?
Yeah, absolutely. When I think about this, we talk about incentivise, but I think to sum up what you just summed, it's about how do we engage individuals in thinking about financial planning, investing, thinking about their financial future. And I kind of think this through, how do we make it accessible so that individuals can access based on their level of wealth or not, as the case may be, to start on that journey. How do we make sure that it's affordable, both by entry criteria in, but also the costs in order to be able to do it? And then how do we make it appealing? And this is where some of the education, I think, comes into play, because we work, and I think it was Nina on one of the previous panels said that as an industry we use such jargon and we make it really difficult to understand. How do you start thinking about investing or trying to manage your financial affairs? So I think we've got to think through all of this, and that's certainly the lens that we're looking at. I think the challenge is then, how do you make it commercially viable? And as a big institution, you start with the strength of having a massive customer base, but you're trying to be all things to everyone, whereas newer entrants can come in and be very specific on who their target market is. But even then, how do they then make themselves commercially viable when they don't have the brand or the customer base? So I think there's various sort of aspects to it, and it's something that we certainly wrestle with at Barclays and peers across, irrespective of which direction people have come from.
Excellent, thank you.
Yeah, I might add to the Asian experience, since Tamara brought it up. That's in some respects, the home markets of Standard Chartered as an organisation. And Tamara's absolutely right. What we see in those markets is a much greater interaction with wealth management journeys in the retail client base that we serve. And there's different lenses to this. There's perhaps a basic starting point, which is segmentation. And what are you making available to different groups of customers? And somewhat recently that saw us introduce an in-between segment, dare I say, between perhaps a priority, very, very mass affluent business and the private banking business. And how do we segment what we make available to that in-between segment, very creatively called priority private. But there's that aspect to it. There is a far greater level of literacy in different populations in the big markets that we serve, certainly Singapore, Hong Kong, China, and other Southeast Asian markets. So the services that we make available to those clients are far more than what we do in other markets. In terms of, I think there's a very interesting point there that you raised, and who is responsible for increasing the literacy in the population? And I think that's something that we certainly do discuss here in the UK. Certainly industry bodies, the PIMFA groups that I've been a member of, have very much looked to lobby government in terms of, we feel we have a responsibility, but there's a broader responsibility in terms of the financial literacy of the overall population, which is, I think, really, we need a broader piece of work there to lift that understanding.
Definitely, I couldn't agree more. Okay, so I think we'll move on to our second question. How can firms bring high-end wealth management services to the affluent segment? And I think, Roxana, you're going to lead on this one.
Sure. I think it's actually a really interesting topic, actually, when we think about bringing those services to the mass affluent, because those high-end services can no longer really be reserved just for the ultra-high net worth, especially if the wealth manager wants to tap into the opportunities that lie with serving the mass affluent. But we see kind of over and over again where there's this assumption that the mass affluent will be really satisfied with basic services, kind of simple products and portfolios, or just a chatbot. And it's absolutely no longer the case anymore. They too really want to see the value of the advice that they're receiving from their wealth manager. Also, we have to remember that the mass affluent can be slightly more fickle, perhaps, because they haven't spent years building that kind of long-term relationship with their wealth manager. They don't necessarily have a very strong brand loyalty. Research we recently conducted found that only 36% of clients have never thought about switching, with the majority having already switched or thinking about switching. So, bringing those services that were perhaps previously reserved for the ultra-high net worth to the mass affluent can really help increase that, that trust, that loyalty, that kind of sticky client. But how do we do it at scale, right? So how do we actually make money from it? And it does come down to technology. So what technologies can we offer the relationship manager to maybe supercharge them? So help them automate some of the more manual tasks and hygiene factors within the organization so they can really do the value add. And then also, on the other side of it, offering the client with self-serve tools and capabilities. Can they download their statements online? Can they update information themselves? Can they perhaps even onboard themselves, through digital capabilities? Ideally, all of these things will be underpinned by a powerful platform. So regardless of what that kind of end client journey is, that platform by itself is a platform that's powerful, can drive STP, and also at the same time, ideally be modular as well, right? Because there'll be more changes, there'll be more regulations that come, there'll be, different kind of investor preferences that are still, yet to be uncovered. Mm-hmm. But by providing a modular solution underneath, we can then plug in new technologies to help us respond to this quickly.
Yeah, absolutely. I agree. It's that sort of future proofing. We don't know what we don't know, and trying to be ready for that. Grant, do you have anything to add on this one?
Yeah, so a few thoughts. We talk about services. What do we really mean? Products, advice, and servicing, right, are the three things I would think about. So first of all, products. There are. If you look at the broad suite of products that firms such as ourselves make available to ultra high net worth clients, at your peril, think about how much you're going to democratise some of that, because certainly the state of regulation, particularly in the United Kingdom, means you need to be very thoughtful about which of those products you're going to take and democratise, given that's the theme of our panel, to a more mass affluent client base. So I think products, yes, more scope if delivered at scale and through technology, but with some careful thought about what those are going to be. We can talk further on that. Advice, I think something we'll no doubt touch on further. The delivery of I don't wish to sound cynical, but seemingly personalised advice to a larger number of clients. Definitely a topic that we can touch on further and how you would deliver that. And then thirdly, the servicing, and I think you've picked up on the servicing part very well. I think clients, regardless of where they are, expect a higher level of servicing, and technology is the only way to deliver that at scale.
So can I just jump in? I also think, and unfortunately I think the title of this session is one of the challenges we face, because we talk about democratising wealth management. Wealth management doesn't mean anything to most people. We're in an industry that should help people do the jobs they need to do or achieve the goals they want to achieve. And I think that's what we've got to figure out, is how do we break down some of the barrier, the stigma, the challenge of overcomplicating it, because irrespective of someone's wealth, people want to tuck money away in savings if they can. Yep. They would want to tuck money away to ensure they can live in retirement comfortably if they have the ability to. They'd want to protect what they've got in terms of their family, their house, those things. So I think what we need to figure out is how do we, using technology, because I don't think it really comes down to thinking about stretching relationship management too far down, because I don't think it's economically viable when it comes to, if you overlay humans onto some of that, you then add, in essence, add cost, which makes it unaffordable then to be able to access the service. So how do we do that? But how do we actually help people to think through the things they need to do, they want to achieve, and then how do we make that more accessible for them to be able to do it?
Absolutely. Right, so let's move on to our third question, which is, to what extent can technological innovations enable wealth managers to scale their services? I think, Tamara, you're going to take the lead on this one.
There was a very interesting discussion prior lunch about hybrid advice, and I want to touch upon a different topic, maybe self-directed investing. I actually believe that the new generation of investors will shy away most probably from getting advice, but they would like to get a much more contextualized, self-directed platform where they can make decisions on their own. So what I would like to see more is different user journeys, not depending on the wealth of the client. So I don't want to distinguish between high net worth individuals, mass affluent, mass retail, but more about the maturity of the client's skill set, knowledge in terms of where they would like to be investing. I can give you lots of examples. I have been spending years in trying to educate adults, consumers, various types of societies about investing. Investing could be the new savings. That's my slogan I use all the time. Sometimes I'm not being understood, I have to tell you that. But what I realize is that people have different type of risk appetites, different type of strategies. One focusing on goal-directed investing, others would like to invest sustainably. We have to touch on this topic. So it's all about trying to understand who your client is at the stage of onboarding them, trying to understand what their experience is with investing and what their risk appetite is. So we build a platform, multi-asset class. And I have to tell you, is 75%, 80% of all transactions on the platforms go to US markets. US markets, 3 stocks. I have to tell you, the first one you would choose, it's Tesla, and then the second 2, most probably Apple and Meta are fighting. But no matter how many markets basically we put on the platform, no matter how much education we are trying to push, there is still actually that kind of a preference and a scenario. So I think we have to spend way much more. Therefore, I believe that self-directed investing should have a bit of a hybrid approach. There should be not advisors in this case, but relationship managers that support the client on that journey. Like 30 to 50% of new investors, they drop out at the stage of onboarding. The first day they open the platform, whatever the platform is, if they're not being contacted by a relationship manager in 24 hours, they will drop out. They will not use the service. Then you might have other cases. I shared with my fellow panelists, you might have users having 40, 50 rejects of orders during the day. Why? They see a message, insufficient funds. Why are you still trying to invest? So there is a lot of actually hand-holding that I believe that we can build even into the self-directed investing part, separately from the advice piece.
Thank you.
Wow, there's a lot in there. There's a lot in there, and there were things that you were talking about at the beginning that I was going to try and come in on. So first of all, platform, and it's not just a high net worth, or it's not just a mass affluent game. Completely agree. We see it, obviously, there are perhaps clients in the $100,000 space for whom I would not try and offer personalised service and face-to-face advice. However, there are clients in the ultra high net worth segment, particularly I think you've touched upon the next generation of clients in those families who absolutely will wish to self-serve and use those same platforms that we might make available in the mass affluent space. So I think we absolutely need to do that. There is a lot more in there, and I think how we build and can evidence knowledge and experience for clients in a particular mass affluent platform looking to invest in, and we've touched briefly on regulation. I think these are really important points. At the upper end, the regulator MiFID II is very clear on what a professional investor looks like. But what does a retail investor with some sufficient knowledge and experience to be engaging in some of these activities look like? And how can we, on a journey, develop and inform those people with that journey? I think is crucially experienced, is crucial. And when you hear someone like Tamara talking about people, it all goes into 3 US stocks. Well, I don't know if there's any professional money managers in the room, but that's obviously wrong, right? Just for the avoidance of doubt, in case you're thinking of rushing out and buying Tesla shares, because we needn't get into investment management theory here, but if that's what's going on, then the wrong outcomes are being achieved for the vast majority of clients, and we need to deliver the right outcomes. And there's something called the consumer duty that means that we've got to be really focused on doing that for our clients.
Do you have anything to add?
Yeah, the only thing I was going to say, I'd echo everything that's been said, and I think looking through the kind of difference between digitising within the self-invested space versus, or self-directed space versus wealth management space, the way we're very much looking at it is how do you remove all of the non-value add tasks from individuals that can do more with that time and therefore arguably our advisors spending more time with clients doing the things that require emotional intelligence, empathy in terms of the conversations. So that's very much what we're trying to work on. It's a challenge because when you come from a business that actually has a lot of legacy systems, you have to peel a lot away before you can actually build that type of digitization or automation in. I think on the other side, the kind of self-directed space, it's the same challenge, but the kind of, for me, this becomes how do you truly commercialize the business? Because on our Smart Investor platform, we've got customers that have a few £1,000s and we've got customers that have tens of millions. And it works for both. But we also then have customers that most wealth management firms that do execution-only trading over the phone. High touch, high cost, and high risk. So we're trying to think actually how do you do that you stretch the execution only up, and then think how do you then, through digitizing, stretch the advice capability down.
Very good. Thank you. Okay, so moving on, we're going to look at the next question, which is how can firms use data and analytics to better understand larger groups of clients? And I think, Roxanne, you're going to take this one.
Sure. I think this is a really interesting question, actually. Before we can answer the how, I think we have to answer the why first. We see it time and time again when firms have tried to use AI and data analytics and implemented tools without actually first answering, well, why is it that we're trying to do this? What are we trying to achieve by implementing a data analytics strategy here? Is it that we're trying to drive better business performance, increase efficiency, increase compliance, surveillance, for example? And absolutely, we can achieve that through, using AI. But actually, without that clear data strategy in place, it's just an extremely costly project, right? One of the key drivers we're seeing is actually using data for hyper-personalization. So understanding the client's needs better, and then through that driving kind of more tailored outcomes for the client. The only way we can really achieve this is having a holistic view of our client. So, what is their wealth within the organization, etc. And we have to kind of pull out data from different silos, because as Graham was touching on earlier, a lot of the incumbents will have lots of legacy solutions. So pulling that data into a uniform way into a data lake, and then supplementing that to really get that holistic view about our clients. So supplementing it with information external to the firm, so kind of LinkedIn or web usage information, or of course within the constraints of GDPR. And that's only when we can drive insightful analytics and insightful actions from our data. I touched on the fact that it can be very expensive and extremely expensive, because we've got to ramp up our infrastructure here. We have to go through large data cleansing projects. We have to hire expensive SMEs that help us on that journey. And really, the challenges are probably quite unique to the incumbents here, because a new kind of challenger bank probably won't have the same issues. They won't have data silo issues. They'll already be capturing data in a structured manner. They'll already be set up on kind of cloud infrastructure. So answering the why first before we go on to that journey is probably a right way of doing it, in my opinion.
Good, thank you. Tamara, did you want to take us?
There is an interesting example maybe I wanted to share with you. I'm just back from Asia, and I was part of a conference where DBS presented their strategy around digitalization and embracing actually mass affluent on their platform. And there was an initiative that I launched that I really liked very much. So what they did is that within their basically self-directed platform, do-it-yourself platform, they really started working on providing different investment themes based on macroeconomic research, fundamental data, news, and etc. So what they started monitoring is how actually a client reacts to this news. So if a client shows interest, then they would tell them, okay, do you want to read more? If you're interested in that, like green gas, energy, let's put it like that. If you're interested, then maybe you will be interested to look at the stocks or these players on the market. Then all this information is being fed into their kind of 360 CRM view that they have built. So the relationship managers could actually see the client is interested in that specific type of a business. Let me have a much more meaningful conversations with them. I have been actually challenging some of my clients, the traditional incumbents, telling them you need to actually put way much more effort in bringing data and analytics and trying to understand your clients' activities. So one of our actually big clients in Central Europe told us, look, Tamara, our clients do not need content. These are hedge funds, institutions. They know everything. They have access to different type of markets. There is no need to put anything in terms of like content, investment themes into the platform. Then we basically run a survey with their users. 75% wanted daily content. It came to a surprise. 75% want daily content. So on day one, they started launching macroeconomic insights to the platform. 50% started opening that newsletter. So I think that what I would like to see specifically from the incumbents is, I would like them to consider is, how can I actually understand what is my client appetite, how the client is reacting to specific type of nudges, investment themes, and how the relationship manager can have a much more meaningful conversation with those clients, yeah?
Yeah, I think that's very interesting. So I imagine most people in this room have investments, are invested, they're in the markets right now. So what's the two biggest questions, the two biggest themes that people are interested in? Yeah, hopefully you're keeping an eye on your portfolios. So in the clients that I talk to, it's where's the bottom, right? and how do I, you know, again, most of my clients are quite experienced, right? They've been through a multiple of financial crises, sadly, as have I. So they're kind of knowledgeable, they're kind of experienced. So it's like, where's the bottom, and how do I position what remains in my portfolio to rebound strongest, right? So there's a whole conversation around that, and that conversation is different to where it has been before, because it's strayed much more away from perhaps, well, there's still a public equity market discussion, but it's straying much more into a private markets conversation. So there's that going on. The second bit is cost of living, eroding value of money, and how do I generate some yield, which I haven't been able to generate for the past however many years it's been now. And that very much then gets into a product conversation that depends on the client, their knowledge and experience, and what their risk appetite is. So, you know, very simply put, if you're after yield, well, you could put together right now a very high quality bond portfolio to generate 10% yield. That you couldn't have done that, right? That was a 4% yield portfolio at the start of this year. So is the client up for that conversation? Do they understand that? Do they understand the risks they're taking? Or there's a structured product conversation. So once again, products which weren't profitable earlier this year for either the bank or the customer, now locking in 6 to 7% capital guaranteed. Is that a conversation that the client's up for? Or if you want to be really boring about it, actually you could do a term deposit and lock in 5% today on the US dollar 12-month money. Tomorrow, possibly more. So, you know, there is that range of outcomes, solutions that to you know, in my experience at least, those two big questions, and I won't go into the first one because it's far more complex, that can see clients with perhaps similar needs seeing a range of different outcomes put in front of them, and how do you put those opportunities forward to the right client, the interested client, the knowledgeable and experienced client.
Thank you. Do you have anything to add here, Graham, or should we move on to the next question?
Probably move on, because data, I think, is one of the most exciting things, but there's far more knowledgeable people to talk about it.
Okay, so how can advisors be better equipped to provide personalised advice to larger groups of clients? I think you might have touched on this slightly, but Tamara, do you want to?
I already did, yes. Yes. I think a lot of investment should be put into really trying to understand behavioral input, activities of your clients, their risk appetite, then bundling them in kind of client segmentations and feeding that data into the relationship managers. I would like to see kind of a, maybe now I'm coming from like the FinTech world, but I would like to see more of like a social trading type of behavioral building within the relationship side of it, yes? So just really trying to understand the clients, group them, and then you would be able to serve a much larger group of clients at the same time.
Absolutely. Grant, do you have anything to add?
I think this is very much a technology conversation. Particularly in the world of hybrid advice. So Graham spoke before about taking away any non-value added steps in a process, services in a process that can be delivered through the most efficient means. And advice, in some respects, I think, is a similar activity. You know, once again, there's a core set of things that you need to understand from a client in order to provide advice. You know, what are their investment objectives? What's their time horizon? What's their risk appetite? What's their knowledge and experience? And are there any other factors that should be taken into account before perhaps making a recommendation to that client? These things are not, there is a defined set of variables here. There's not too many of them. And one can appear to give personalised advice to a client based off, you know, some reasonably straightforward, almost decision tree-based logic that takes you from the start of a conversation to a personalised recommendation, and delivering that perhaps. And I think we've spoken about hybrid advice, and I think hybrid is absolutely right. It's a very different experience for a client, investing their hard-earned money, so hard-saved money, and they typically, and particularly in the UK market, are looking for a degree of validation with what they're doing. And so I think that that's delivering these services using technology, arriving at the right solution and enabling a hybrid level of advice, but maintaining, you know, strong cost control is key.
Wonderful.
I think this is where actually hybrid advice, typically we're talking about with a human interaction of some sort, whereas actually, and we've seen it in the US, very successful, termed robo-advice, guided advice, digital advice, and I consciously use those three terms kind of interchangeably, even though they're not really, if you were looking in the truest sense, but consumers don't know the difference. In the UK, we've had a number of firms. You could look at 3 FinTech firms, you could look at things we're doing or other banks are doing, and people would use the same terms interchangeably, but they're actually all very different. But guided advice or robo-advice or guided journeys, I think that is a place that still has a huge amount more potential, because a lot of people, if they can't afford to pay for advice from a human advisor, because there are some thresholds that from an economics perspective, then actually research we've done is people then often say is, what do people like me do? And therefore, how can I think through my decision tree that actually I end up in a solution that feels right for me, because I know other people that are in a similar position, similar perspectives, similar interests or beliefs actually end up in. So I think that's where, as an industry, we need to get better at articulating what these propositions are and aren't, but making it easier for people, and then that enables firms to scale as well.
Absolutely, and I think this comes back to the earlier conversation of people just generally having that heightened understanding of like what are the first things that you do with your money when you start investing, and not actually needing to go and ask for advice for those things, and then when they know they've got extra money, actually what might be my options now, you know, and again, do I want to do something risk adverse or not, you know, how disposable is that extra income is the question. So yeah, thank you. I think we're going to move on to our last question now. So how can traditional firms compete with self-directed platforms? And I think, Grant, you were going to take this one first.
Goodness me, several ways. Let me offer a bunch of different thoughts, and some of these are from my current role, and some of them are from previous roles. You know, first of all, we were chatting previously, you know, very, very difficult, right? The legacy systems, large numbers of clients for whom you've advised and put into positions previously, mean that legacy firms do have a number of challenges in front of them. And turning the supertanker, so to speak, is pretty tough. So a couple of things that I've seen. One is very much at a previous firm, the codification of the advice journeys and the outcomes that leads to. So whether that's then still going to be delivered in a hybrid face-to-face model with some very streamlined systems behind it to enable the very rapid fulfillment and follow-up to that advice, or, as Graham's mentioned, ultimately putting that in a purely digital manner that enables the customer to self-serve that, validate, is that what people like me do, is something that I think legacy firms, incumbents can do. A couple of other things, and something that we are doing at the moment, is you just set up a new business. So we, Standard Chartered Ventures, most obviously in Asia once again, you know, very much in the business of setting up new banks. So, you know, we've got a great deal of experience and expertise in what we do. However, how do we perhaps use some of our knowledge and experience, set up a new platform, partner with someone, and partnerships, I think, is a key part to this, who can perhaps bring a different customer base to the customer base that you're currently serving, and then offer their new banking services to that customer base. I think that's another thing. And then thirdly is really look for your niche. And one of the ventures that we're pursuing at the UK that's been announced is a new sustainable bank called Shoal. Shoal will be very much focused in the sustainability space, and again being very clear for retail customers, looking for deposit and investment activity that they know is going to make a change for good, to invest in products which they can guarantee can take them there. And there are real benefits and opportunity, ways of thinking about that for a legacy player. Shoal will be a standalone and different bank to anything in Standard Chartered. However, one of the customers of Shoal, from a balance sheet perspective, will be Standard Chartered. We have about £4 billion of green loans that we've made to customers in our investment bank in the UK, and we could now finance those potentially from depositors looking for green deposits, sustainable deposits, to say, well, actually, you know, how do I make sure my money's doing good? And whilst it would be difficult to do that for us as an incumbent player, through a platform like that, we can still participate and become more engaged in the whole area of sustainability, which we absolutely see growing.
Absolutely, I couldn't agree more on that point. Graham, do you want to add?
Yeah, so I think your question was around the traditional kind of advice-based firms and competing with the execution-only firms. And actually, I think on one hand, both sets of firms need to do the same thing around investing in technologies and enable it to deliver better and more sustainable commercial growth, but also the right outcome for clients. But I think actually what every firm's got to do, whether you're an execution-only platform, Hargreaves, or whether you're a big institutional wealth manager, us or someone else, is you've got to come back to the point, I think it was Grant said, who's your target market? What are you trying to serve? And don't just try and compete just because you think you can. And then because actually one choice could be, we don't want to. But then if you do, how do you think through, and I think again, one of the panel sessions earlier, how do you think through who you can partner with as a FinTech technology firm out there rather than try and do it yourself, or you do it yourself, or as we're seeing at the moment, there's mammoth acquisition activity going on, whether that's consolidators within their own sort of space, or whether that's consolidators trying to diversify into other spaces. So I think, and I don't think there's one answer for any particular firm, because they're all fraught with challenges as well as good opportunities in doing that.
Thank you. I wish we had more time because I feel like we could talk a lot more. But I think that our time is pretty close to the end. We've probably got a couple of minutes maybe to answer one question. Let me just have a look and see what I've got here. Let me see. Oh, some of these are quite topical. This one maybe is interesting. How important do the panel think it is to have a 360 view of a client within CRM? And is data the biggest challenge in order to achieve this? Anyone want to take that one?
I think I already touched upon that.
Yeah.
Like extremely vital and important for you to understand how you can scale up the product offerings, etc. So we were actually challenging ourselves before that session, how much of Barclays and Standard Bank are doing into that space. So Grant.
I think it depends on, so from my perspective, what do you really mean, whoever wrote the question, when you say 360? Are you talking about what's within your organization and the data there? Or are you talking about more broadly what a customer holds outside the organization? So obviously the first of those is reasonably straightforward. One hopes you have a pretty good view of all data in the organization, but that is only ever going to be very limited. You know, the clients that we serve across the piece will have at least, at least 3 to 4 relationships with different firms. Again, to give you perhaps a simple example, if I wish to sell private equity funds to a high net worth client, there are concentration limits, right? So when I'm thinking of 360 view of a client, I'm thinking about what's the total invested wealth holdings of that client, how much of it have they put into private equity, and if my guidance is that up to, again, this is not investment advice, I should be very clear, if up to 25% of a portfolio now could be considered in off-market private assets, has the client got headroom for me to engage in a new conversation about private equity investments with that client? Yeah. So when I'm thinking 360, that's what I really want to know.
Wonderful. I think we've got one that we could just answer a yes or no to, since we've only got 30 seconds. Does the recent financial turbulence and rising cost of living present an opportunity to wealth managers?
It's an opportunity and a challenge. Is so not yes or no. So yes.
Sitting on the fence there.
Anyone else?
Yes.
But.
Thank you. Yeah. Yes, but.
And this is not the financial advice.
One has to be open to what type of conversation are you going to be having with your customer or your client. It might not be the one that you think you're going to have. It might not be one about a traditional bond and equity portfolio that looks like a 60-40 split. It might be something very different, depending on what the client's looking for.
Thank you, and haven't they made my job easy today? So put your hands together for my panel.